I'm Barnaby Rugge-Price. I'm the chair of Howden UK and Ireland, a global insurance and reinsurance-based business here in the UK. And I've got the remnants of a cold, so there's a bit of coughing and spluttering. Please accept my apologies for that. But it's fantastic to be speaking to you here today at the Conduit Club and to be addressing some of the movers and shakers in public policy, academia and industry. And it's also fantastic to be shining a light on insurance, which is apparently a bit of a dry topic, if not downright boring. And yet it couldn't be less boring, and it couldn't be more important. Without insurance, the expansion of shipping trade in the 17th century would have been dead in the water. Without insurance for steam boilers, the Industrial Revolution of the 18th century would have evaporated. Without insurance, the dawn of the age of electricity in the 19th century would have shorted out. And without insurance, some of the institutions on which our modern world depends might never have got off the ground. Take the blueprint for our welfare state. It was in 1942 that the Beveridge Report undertook to slay 5 giants of idleness, ignorance, disease, squalor, and want. A task it framed through the prism of social insurance. And if we need proof of the value of insurance today, we don't need to look far. Insurance remains one of the city's finest performers, with a UK premium equivalent to just over 10% of GDP, and London still the dominant market for specialty insurance classes of marine, aviation and energy. On a personal level, I know how vital insurance can be for businesses and for people's livelihoods. I've worked in the industry for over 30 years, always based in London, yet by virtue of this city's preeminent position in the global insurance marketplace, I spend the vast majority of my time working with clients outside of the UK, helping them manage some of the most complex risks and exposures across the globe. My own specialist insurance subject for the past 30 years has been property, spending the majority of my time dealing with what we in the business call NatCat, or natural catastrophes: earthquakes, severe weather, windstorm, flood, and tornadoes. And for those unfortunate enough to be caught up in such disasters, insurance is their safety net, their lifeline. But in recent times, something has become increasingly and uncomfortably obvious to me. We used to think of NatCat as a once-in-a-lifetime event. We would talk of 50 or 100 or 250-year events, and our negotiations discussions focused almost exclusively on earthquake and windstorm. Sure, floods occurred, so did tornadoes, but they were unpredictable and infrequent. And as for wildfires, well, they were things that looked frightening on the news, but were generally confined to the countryside and didn't impact major urban areas. Well, not anymore. In fact, the insurance cost of natural catastrophes has exceeded $100 billion every year this decade. And in half of those years, that figure has been achieved by events that were once considered second tier: wildfire, flood, tornado, and without a single loss from an earthquake or a named windstorm, the two perils that we used to consider to be the real NatCat. 15 years ago, this would have been unthinkable. But as we scroll the news over the last 12 months, we've seen supersized hail in Germany, floods in the UAE and Oman, wildfires in Australia and California, and this is now normal. Those recent fires in the Palisades are also part of a broader problem. Weather events are becoming more severe, more frequent, and more complex. The authorities are pretty good at predicting and putting out a blaze. In fact, that's why there were so few fatalities in California. But they still find them hard to stop. The Palisade fires were complicated by winds in excess of 80 miles an hour, which stopped helicopters and planes getting into the air to douse the flames of a fire that was moving at the speed of 4 football fields a minute. And we've seen the consequences. Homes, livelihoods, businesses, schools, whole neighbourhoods went up in smoke, causing an expected industry loss of 40 billion. In fact, I saw a figure today saying it's creeping up to 50 billion. And as a typical rule of thumb, the total economic loss will be at least 5 times that number. Of course, extreme weather is only one facet of an increasingly tangled risk landscape. We're having to cope with NatCat, but also what we might now call ManCat. International conflict, strikes, riots, civil commotion, as well as energy and food insecurity, are all exacerbated by population density and failing infrastructure. So what does all this mean for insurance? One immediate consequence has been the widening of the insurance protection gap, the difference between insured and uninsured losses, frequency of payouts, and the difficulty of raising premiums, often because of well-intended but counterproductive regulation, coupled with the assumption that the government in the end will step in to cover the risk, have eroded insurers' profits and led them to pull coverage in high-risk areas. And we continue to build homes in places where we shouldn't. On UK floodplains, in California hills, next to the sea in Miami. When the levees failed in Katrina's wake in New Orleans 20 years ago, the famous French Quarter escaped flooding. Why? Well, because back before levees existed, they knew they needed to build above sea level. The effects of this widening protection gap are being felt the world over. In Europe, it's harder to get flood insurance. In California, up to 80% of the homes affected by fire were underinsured or not insured at all. Keep this up, and in the coming years, we will be plunged into an insurability crisis. Because we're living in a new age of instability, the norms that we once took for granted have been turned on their head, the rules-based order is being challenged, old alliances are being shaken to their core, and extreme weather events are increasingly common. Which means in the next quarter of a century, we're going to need more insurance, not less. After all, without insurance, you simply can't manage these risks, and what is uninsurable becomes uninvestable. So we're at a crossroads. Either we fail to insure communities, passing on unaffordable burden to consumers, or the government takes up the slack, putting impossible pressure on already constrained budgets. And the only way to sever this Gordian knot is for insurance to step into the spotlight. Instead of being seen as a monthly direct debit sold to you by meerkats, it must be regarded as a transformational tool, able to use its mastery of catastrophe modelling and risk management to tackle tomorrow's intractable problems, and critical to unlocking finance for industrial decarbonisation technology. We often read about what insurance fails to deliver, but far less about what it delivers every day. To return to the recent California wildfires, the insurance industry is currently paying out billions of dollars to the people affected by that event. Or consider a charity incubated by Howden, backed by the insurance market, Humanity Insured. Launched last year, it is using parametric insurance to make insurance accessible for those on the insurance front line. With satellite technology, we can now predict when a climate disaster will occur and trigger an automatic payout for those affected. As an example, many smallhold Kenyan farmers are unable to operate without loans from credit unions to buy seed and fertilizer. So when nature strikes and harvests fail, farmers find themselves unable to make loan repayments. But thanks to the efforts of Humanity Insured, whenever extreme drought or excess rain reach a pre-agreed criteria for a given location, those Kenyan farmers now automatically get a payout, preventing them from defaulting on their debt whilst ensuring they have the money to feed their families and keep their children in school. In 3 months, Humanity Insured has mobilised more than $50 million of insurance capacity to help over 1 million people in communities from West Africa to Papua New Guinea. And it's ready to protect 3 million more. Parametric insurance is now so sophisticated that Humanity Insured is supporting an NGO in East Africa to insure themselves ahead of flooding. In future, when extreme rain hits the lakes in East Africa, communities along the river will get a guaranteed payout weeks before any flooding occurs. So they can prepare, move to safer ground, and vaccinate livestock. And this is just a taste of what insurance is capable of. After all, insurance is the foundation stone of finance and governance, and you can't get credit, and you can't release capital without it. But if we could harness insurance's great power, a mighty conduit, you might say, through which the government, the financial industry, and the private sector can unite, then we would have a powerful weapon to manage some of the giant risks we face in tomorrow's world. And the good news is, that isn't just a theory, it's already happening. So let's look at 5 of the giant risks that we're taking on, starting with floods. The past 2 years were amongst the wettest on record. As someone with an interest in property insurance, I find it unnerving to think that 6.3 million properties in the UK are now at risk from flooding, a figure that's likely to rise to around 8 million by 2050. In April last year, the Association of British Insurers said the annual cost of weather-related home insurance claims had risen by a third to a record £585 million. But as we'll hear later on, there's a new flood management project coming on stream that's looking for solutions. Their ambition is simple: to make land available for floodplains, to allow water to flood in the right places, to protect towns and create more natural assets like wetlands, and to reward those who let their land flood with greater insurance and mortgage access. But it's not just flood risk we should be thinking around, but food risk. Food risk is an increasing issue. Howden has been modelling the growth in climate-related agricultural losses in key regions over the coming decades, and we've discovered that some of the key crops in drought-exposed regions could see a doubling of their expected agricultural losses in the next 25 years. This will affect everyone, from smallholder farmers in Central America who benefit from Howden's micro-insurance protection to major producers in Australia, Europe, and North America. The implications in terms of economics for farms and farming regions, never mind food security, is salutary. The protection gap in Europe is 75%, or put another way, that means that only 25% of agricultural losses are insured or protected, and in emerging and developing countries, that figure will be much lower. Not only will that mean that insurance is more expensive, but as financial regulation and credit rating agencies require lenders to evaluate and disclose their climate risks more effectively, access to credit will be restricted. And if that happens, we'll see credit droughts as well as real droughts. So we must not only ensure that we maintain access to credit for farmers, we must also ensure that banks can continue to provide that credit. Again, answers are not a million miles away. In Africa, countries have joined up to create a mutual insurance company, Africa Risk Capacity, to share risk and access to international markets. Indeed, this is just one of the many insurance innovations that have been pioneered over the last decade outside of developed economies, and a brilliant example of how technology transfer from emerging economies to developed ones, and an illustration of how we need to share both risk and expertise globally. Of course, the challenge we face today is broader than just these physical risks. It's also about the need to de-risk new technologies, supporting renewable technology as it powers the transition, which brings me to my third risk, which is energy risk, where creative startups producing renewable innovations often face the same barriers to success: tech failure, credit risk, supply chain disruption. Insurance can help tear down these walls. It can unlock finance for transition, enabling key decarbonisation technologies. At Howden, we've worked in partnership with Aviva to create a construction and operation cover, a policy for solar energy construction service, SunSave, whose aim is to make solar energy accessible to all UK households. Insurance can also promote carbon capture and storage and carbon credit and validation insurance to bring confidence to the carbon market. And both technology and food are impacted by my fourth giant risk, global security. Consider how COVID affected car supplies because of a natural shortage of semiconductors, or how conflicts in Ukraine and Middle East have hiked up food prices as a result of disruption to international shipping in the Black Sea and the Red Sea. Again, insurance is on hand. At the start of the Ukraine conflict, my company helped broker an insurance for a vessel chartered by the United Nations to alleviate food shortages for hundreds of millions of people in the Middle East and Africa who relied on Ukrainian grain. Our first of its kind cargo war facility was designed to protect vessels from drone and missile strikes by Yemeni-based militia groups in the Red Sea. And the final giant risk I'm going to touch on is something that wasn't even an issue when I was growing up: cyber. Last year's global outage caused major disruption and an estimated $1 billion of losses, the biggest cyber loss ever, and a stark reminder of our dependence on the digital world. Yet, much as insurance companies forced other companies to implement safety measures for steam boilers in the 19th century, so cyber insurance has made a major difference, compelling companies to put in the correct cyber controls. Our challenge now is to make sure that SMEs much less likely to have this type of insurance, and much more likely to feel the pain of a cyber strike, get covered. Still now, more than half of the business in the UK, well over 1 million private sector companies, have suffered at least one cyber strike in the past 5 years, and the amount of lost revenue clocks in at a whacking £44 million. Which is why we've worked with insurance providers on innovative products like Cyber Plus, taking the hassle out of getting a cyber insurance policy and reducing the time it takes to fill out of a form from days to minutes. So in a world of mounting instability, insurance in partnership with others is offering a way forward. But to succeed, it requires all of us in this room, physically or otherwise, to play our part. My industry must continue to innovate and seek to remain relevant. And although I've given you examples of what we're doing at Howden, I know there are many people across our industry, quite a few of whom are here today, who are also looking at how they can play their part. Collectively, we know the insurance industry not only can, but more importantly wants to play a pivotal role in confronting the challenges ahead. But we need governments and the wider financial sector to recognise our potential, no longer regarding us as an afterthought. Instead, we must reimagine insurance, seeing it for what it is, the great enabler, and in doing so, to attract the young talent into the industry that will help us to safeguard the future. And that's why it's fantastic news that the Conduit Club today is launching a new insurance society. A society where all of us, from insurance, from government, from the private sector, can collectively discuss some of the burning issues of our day, broach the toughest of subjects, and devise the most innovative solutions. Together, we can be a force for good, the beverages of the 21st century. And just imagine, if we can take on the giant risks of today, from food to flood, from energy and security to cyber, and beat them, what an incredible legacy that will be to pass on to the next generation. Thank you very much.